In this video, we will look at how long it would take you to double your investment by comparing common passive income such as money market funds, real estate, SACCOs, bonds, and fixed deposits. We will use the rule of 72, which is a simple formula that helps you calculate how long it would take to double your investment based on the average return rate. So what you do is divide 72 by the fixed annual interest rate to find the number of years it takes to double your initial investment. Let's get started. First, we have money market funds. So money market funds aim to provide investors with stable returns while keeping the investment highly liquid. Returns are typically in form of interest generated from the underlying securities in the fund's portfolio. Returns can vary based on the performance of the said securities. For this video, we'll use the average returns of money market funds as between 10 and 12%. So if the average return is 10%, then you divide 72 with 10 to get 7.2 years. On the other hand, if the annual return is at 12%, then divide 72 by 12 to get 6 years. This means that the average time it takes for your money to double in a money market fund is between 6 and 8 years. MMFs are ideal if you're looking for low-risk investment and for short to medium-term saving goals. Remember that the returns can fluctuate month to month. Now let's look at SACCOs. For this video, we'll use 10 to 12% as the average return for SACCOs on both deposits and dividends. SACCOs allow members to save and earn interest on deposits by receiving yearly dividends depending on the SACCO's performance. So if the average return was 10%, 72 divided by 10, that means you'd take 7.2 years to double your investment. On the other hand, if the interest rate average was 12%, that means it would take 6 years to double your investment. So for SACCOs, 6 to 8 years again. So SACCOs are good for consistent savers and also for saving for goals such as buying land or school fees. Note that SACCOs are less liquid than money market funds, and some require notice for withdrawal. Next, we have bonds, which have an average return of 15 to 17%. So bonds, especially government bonds such as treasury bonds, offer periodic interest payments for a fixed term with predictable returns. In Kenya, bonds such as the infrastructure bonds are tax-free, which makes the returns for investors even better. So if the average annual return was 15% for bonds, that means that 72 divided by 15, you get 4.8 years. If the return was 17%, 72 divided by 17, that would take 4.2 years. So this means that the average time it would take for your investment to double if it's in a bond is 4 to 5 years. So bonds are good for medium to long-term investments for investors who are seeking steady income. So bonds may require longer holding periods, and the secondary market sales may affect liquidity. Then we have real estate, which has an average return of 6 to 8% on rental income after costs. The return on real estate can vary based on location, occupancy, and even management. However, using the average, if you're to get 6% net return, then that means that 72 divided by 6, it would take you 12 years to double your investment. But if your annual net return was at 8%, this means that it would take 9 years for you to double your money. Real estate is especially good for long-term investors who are looking for stable income. However, to invest in real estate, you need a high initial investment, and property management is also required. Finally, we have fixed deposits. So fixed deposits are offered by financial institutions where you put in a lump sum of money, then you lock the interest for a pre-agreed duration. They typically offer higher interest compared to regular savings accounts, which make them ideal, especially if you're trying to build savings habits. So the average return is 6 to 8%, and if you are getting 6% in return, that would take you 12 years to double your money, while if your annual net interest is 8%, that would take you 9 years to double your investment. This investment vehicle is good for capital preservation and short-term savings goals. For this account, your funds are locked for a specific amount of time, and the returns are typically lower than money market funds. So the higher the interest rates, the lower the number of years it takes to double your investment. Money254.co.ke has written on this and more personal finance topics. Click on the link on our bio to learn.